There is no way in but I will pay this much for this, so I can get this kind of gain, all while still getting paid a dividend. So how do you determine what's a good price to pay for a stock so you can actually make money and a lot of it and not lose money? Now in this video, I'm going to break down to you the concept of how do you determine what is the right price to pay for a particular stock. And I'll give some analogies and real world examples so that we can truly understand this concept. Now paying the right price is extremely important if you want to actually make money in the stock market. If you pay too high of a price for a stock, you increase your chances of not making a lot of money, or worse, actually losing money with a stock. If you pay a great price for a stock though, you increase your chances of seeing gains like these. Now, in order for you to understand how to pay the right price, you first need to understand that investing is more of an art than an exact science. Two key things that you need in investing are business instincts and money-making instincts. And I'm going to show you right now that you already possess these things. Say there's a money tree, and this money tree grows $1,000 every year that you can pick from the branches and put it in your pocket and spend it how you please. And you want to buy this tree so that you own it and it can produce $1,000 every year for you. How much would you pay for it? Y'all like that, huh? Yeah, I know. How much? Now, if you said $1 million, it doesn't mean that you should just pack it up and go home because you're doomed. It just means that for you, we have a little bit more work to do. That's all. So watch this. If you bought this tree, then it would make $1,000 for you every year. So if you paid $1 million for it, you divide it by the $1,000 that it will produce for you every year, and that'll give you $1,000. So how you can think about this is, if you paid $1 million for it, then it will take 1,000 years for this tree to make back the money that you paid for it. Now, this is a classic example of overpaying for an asset. You're not going to live 1,000 years, so this tree would never pay you back the money that you paid for it. So the only chance that you would have of being profitable after paying this high of a price for this tree is if someone else comes along and pays an even higher price than the already high price that you've paid for it. Now, if you paid $3,000 for this tree, on the other hand, divided by the 1,000 that the tree produces every year, then it'll take the tree 3 years to make back the money that you paid for it. Then you'll own the tree still, and it'll continue to produce $1,000 for you every year. Now, companies in the stock market aren't money trees, but they are businesses that you can buy, and they'll continue to earn cash for you year after year. And this is partially why I decided to buy Synchrony Financial. Now, this tells me that I could buy one piece of Synchrony Financial for around $42, or I could buy the whole company for around $24.5 billion. And then I can see how much cash this company, or quote unquote money tree, has been producing by going over to the cash flow statement. And I see that in the last 3 years, it's produced an average of around $8 billion of free cash flow per year. Now, if I take the price that I'll be paying for the whole company and divide that by the average free cash flow that this company has produced over the last 3 years, 8.7 billion, I get about 2.8. So I know that if I bought this company outright, it'll pay me back my investment in about 2.8 years. And I'm willing to take this risk because I feel like this company will continue on and grow for more than 3 years, and it won't have a dramatic drop off. And because the stock price is just the market cap divided by the total number of shares outstanding in the company, I know that this is around a good price to pay for this stock. Now, if this stock was priced at $400 instead of $42, and it still had the same number of shares outstanding, I probably wouldn't have bought it. But when you pay the right price for stocks, you get this plus this. Oh, how did that get there? Now, I want to use two more analogies and one real world example to help us to understand what the right price is to pay for a stock. And I feel like these will really help to drive home the point. Now, when you're looking to buy stock, don't just think about it as a price or a dollar amount, but instead think about it as you'd have to pay this price to get something in return. So now you have to figure out what are you getting in return. For example, for the ladies, let's say you want to buy some foundation. So let's just say that there are two different foundations that you can buy. One costs $500 and then the other costs $20. Now, should you look at these and say, I'm just going to buy the $20 one because it's cheaper? Of course not. Like, whoa, slow down. You have to know what you're getting for these dollar amounts, and I haven't told you yet. So for this $500, you be buying your favorite foundation, whatever brand it is, And it's a huge container that won't run out for 5 years no matter how much you use it. And for this $20 one, it's terrible quality, and after the first time you use it, it runs out because there's such a small amount of it. You're probably thinking like, I'll be paying $20 for bad foundation that will only last me one use. Like, nah, I'll buy the $500 one because this is a great deal for what I'll be getting. Now for the fellas, I won't leave us out. Let's say you want to buy a game system and your options are the PS5 at $500 or the Xpeng 2000 at $19.99. Now for the PS5, you know what you're getting. Great games, great graphics. You can play online with your friends. You got multiple controllers. It's a great experience. Now, on the other hand, with the Xpeng 2000, you have terrible graphics. You can only play one game because it's only one game for this system. You can't play with friends and you can't play online. None of that. Now, when you look at these, which one is the better buy? Yeah. So the point is, just because something is a lower dollar amount doesn't mean that it's a good buy or a good price to pay. So when we look at two real companies in the stock market, Tesla and NIO, we see that Tesla is priced at $665 per share, and NIO is priced at around $42 per share. Now, new investors usually come in and say, Tesla is priced at $665 per share, and NIO is priced at $42 per share, so I'm going to buy NIO because it's cheaper, and it'll probably go up to $600 per share just like Tesla did. Now, at these stock prices, Tesla has a market cap of around $636 billion, and NIO has a market cap of around $66 billion. So if you wanted to buy each of these companies outright, you pay about $636 billion for Tesla and $66 billion for NIO, plus a premium. Now let's first look at Tesla and see what you'd be getting if you chose to buy it for $636 billion. Okay, so you see that free cash flow was around $2.7 billion in the trailing 12 months. Now, if you take the market cap and you divide it by the free cash flow like we've been doing, you get around 236. And again, you can think about this in years. Now, I think Tesla will go on and grow and produce more cash in the future, but as it stands today, if you chose to buy it at this price and this price, then it will take around 236 years for Tesla to make your investment back for you. If you chose to buy it and hold it and not sell it, but just to take the cash from the company. Now, let's look at NIO. Now, I want to be clear. I think that both of these companies are extremely overpriced, and I wouldn't touch either one of them with a 10-foot pole today. But are you starting to see why NIO wouldn't be considered cheaper just because it's a lower price than Tesla? By the way, this is not available because, it's negative. They're losing cash. So I really can't expect the company to make my cash back in any amount of time. So if you were expecting me to show you some kind of equation or formula so you can apply that to any stock in the stock market and make money, I'm sorry, it doesn't work like that. Again, investing is more of an art than an exact science. So you need to use your instincts. If you pay this much for a company, how quickly do you think the company will pay you back your investment, plus continue to earn you cash so you can be profitable on your investment? Will it take 3 years, 10 years, 20? Do you feel like the company will be around long enough for it to pay you back plus some? So in the end, there's no shortcut. There's no way around actually understanding the business and being able to read financial statements so you can be a great investor in the stock market, and you can pay great prices for stocks so you can actually make money. And this is why I make videos about the fundamentals of investing and teach business concepts on my channel, because I want to set you up for success. So with that being said, here are a couple videos that can help you out in the stock market.
It's like if somebody walked in the door here and they weighed somewhere between 300 and 350 pounds, I might not know how much they weigh, but I would know they were fat. And that's all I'm looking for, is something that's financially fat.